Joining us here at Post 9 is Bespoke Investment Group co-founder Paul Hickey. Welcome, Paul.
Hey, how are you?
So you think this rally is for real?
I mean, we were very oversold. The market's breathing a sigh of relief. We're not going to get, on the anticipation of no more rate hikes. And plus, the geopolitical temperature is starting to lessen here. So I think, you had this very big, the impact of what happened over in Israel and the Middle East shouldn't be underestimated on the impact of the market in September. And I think, we're starting to breathe a sigh of relief here. The Fed is basically done when you have Powell saying, the dots can get stale.
Decay was the word.
Decay. I think Constellation rang the bell. I mean, yeah. I think he's planning to go sit on the beach in one of those Corona commercials for the next several months.
With the autographed line from Eli Manning, that one right there.
There you go.
But if the whole rally is predicated on the fact that the Fed is done, are we sure the Fed is done? Because there's a 20% chance in the markets that they hike in December. Powell left the door open to keep tightening if inflation doesn't continue to come down, and the data's running a little hot.
Right. Well, I don't think necessarily that the market is rallying strictly on the Fed. Today, but this is a 4-day rally now we're looking at. And so we were up Monday and Tuesday coming into this. And I think we were at oversold levels. So I think you're starting to see the earnings picture improve as far as the results are going relative to expectations. And guidance hasn't been, it's been weaker than prior quarters, but it hasn't been, it's in line with the historical average. We're seeing more companies lower guidance than raise guidance. But how can you blame them given the uncertainty out here? When we were leading to the buildup of war in Ukraine last year, we had 2 negative quarters of GDP sandwiched in between that invasion. So I think it would behoove someone to, be very bullish on their outlook when they're reporting.
Paul, you've become, you and your firm Bespoke have become kind of synonymous with this idea of looking at market history, looking at some of the patterns that have emerged. I wonder if you take a look at what's happening right now. We talk about the intra-season or intra-year price drawdowns in the market that are prevalent on a normal year. We got a decent amount this year. Do you feel as though we're done now at this point? Can we be more optimistic that there's no more pronounced downside in a seasonably strong time for the market?
Right. So we are in what's a seasonably strong year. And again, going back to the historical trend, if you overlaid this year's pattern over to the typical seasonal pattern, it was like step for step, the ups and downs. It was until Hamas went into attacked Israel that we started to see the divergence. And I think if you can see it tone down in that temperature, that's going to help the market going forward in what is a seasonally strong time of year. And think about this. The Fed hasn't done anything in the last 2 meetings. Financial conditions have tightened by just as much in the last 3 months as they did last November when they had hiked 4 times in a row, 75 basis points. So we've seen a big tightening of financial conditions over the last 3 months. And when you tend to see that, the rubber band or, the baby can only scream so long. Eventually they calm down and we get back to a more stable situation.
So let's talk about small cap stocks with little to no debt. That's the call, right?
Right. So you look at small caps, they're down a third from their highs. They're in the third longest losing streak without hitting the 52-week high in the Russell's history. And the total return over the last 5 years of the Russell 2000 is under 10%, not annualized, 10% gross return. So when you look back at those periods in the past, small caps tended to outperform going forward. And you always want to ask, is there something different right now, right? So what's different now is there's a lot of companies in the Russell 2000 that are zombie companies that were funded on 0 interest rates, and they may not be able to refinance. So if you look within the Russell 2000 of companies that have the least amount of debt, they're down about 15% over the last 3 months. The companies with the most debt are down 30%. So I think if you can pick and choose of these smaller companies that aren't necessarily going to have to rely on the credit markets to keep themselves in existence going forward.
But it's a weird